Welcome to Money Secrets with Bill and Mike.
I'm Bill Alexander.
And I'm Mike Tove. And Bill, you know, we had a really good episode not long ago and talking about taxes, and I think we needed to get a little bit more into it.
Well, I'm delighted that we have John Rakowski back.
Right.
He's an enrolled agent, tax planner, does a fabulous job, and you know, getting down into the weeds about what small business people can do to reduce their taxes is a huge issue.
When we come back, let's see what we can do about that. So, Bill, we've got John Rakowski back again, and
well, we're delighted to have you back, John.
Thank you.
Rakowski and Associates is well known for tax planning, and we're delighted that you're with us.
Great. Thank you very much.
Yeah. So, we're talking about small business, and you know, that's a very different thing from just being an employee, isn't it? And so, so advising a small business owner in terms of how do you maximize your...
Well, let's start out with the big picture.
Right.
What's the biggest problem that you see as a tax planner for small business people?
Hands down, it's lack of tracking. Anywhere from receipts to understanding how to take money in and out of a small business account. Is it legal to do that in some cases? Is it blended together? So understanding the structure of the business you're in, how it works and what its limitations is really very important.
So in essence, you're not supposed to go to the grocery store and take your business checkbook with you to buy supper.
Correct. We just an example. We had an audit some time ago that the client got audited because he claimed $5,000 worth of meals, and he felt that he should be able to deduct all of those meals, and we told him that he probably shouldn't. So he was prepared to go into the audit. At the end of the audit, he ended up deducting $1,000 worth of meals because he didn't understand the law, and that was before he came to us. We told him what he should be doing.
Well, you know, I know that for a lot of small businesses and consultants, if you will, one of the big questions that they ask is, how do I deduct a vehicle? You know, what are the best ways to do that? What are their options?
Sure, they really have two options. Number one, the mileage, the standard mileage rate that the IRS proposes each year. And then the second one is to write off actual expenses that they incur.
Well, it seems to me like if you're driving an older vehicle, writing off the mileage seems to be the way to go.
It is always the way to go unless your car or truck gets 14 miles per gallon or less.
Right.
Now,
is that the actual number then? Is that the
That is
magic
my
number?
Calculation from 34 years of experience.
Wow.
So yes.
So if you have a gas guzzler, you might want to do it the other way.
Correct. Now, the way the law reads is that the first year that you decide to either take mileage or take a depreciation or the actual expenses, if you take depreciation in the first year, you must continue with that from every year thereon.
Right.
Right.
If you take mileage, you have the ability to go back and forth between actual expense or mileage in any given year. So if my truck drops a transmission or an engine, that might supersede or be greater expense than the mileage.
Okay.
That's where the planner comes in.
All right. Well, if I'm a business person and I need a new vehicle or need a newer vehicle, does it make a difference whether I buy a brand new vehicle or maybe one that's a year or two old?
You've got to have either way you can depreciate a vehicle, but if you want to take the bonus depreciation that currently exists, it's got to be new. That's the law.
So it has to be brand new to get the bonus depreciation. Now, what's bonus depreciation?
It allows you to write off a much greater amount of that truck. It also, even though you're able to write that off and get the deduction, if you buy another truck in 3 years and you had the first loan for 5, you are now trading in that older truck for a newer one, and that impacts how much you can write off the new truck.
So it can be complicated. Now,
Yeah.
As I recall, some of the larger vehicles over a certain tonnage, that you can actually write off the entire amount in 1 year, can you not?
Yes, you can. It depends on the weight of the truck, and like you said, it's the much larger ones.
But for most folks that want a normal sized car or even a smaller truck, you cannot do that.
You cannot write off 100%. You're going to get a much greater depreciable amount originally, and again, it could work to your deficit years from now.
But what about people that are in sales areas? For example, real estate folks, because they're showing houses, they're using their own vehicles, if they're using their private cars, I'm not
Right.
sure they can do much except for write off just the mileage, but I assume they have to keep separate records, right?
Yeah, they can write off the depreciation, but the mileage for a realtor, hands down, take it every day. Absolutely.
Because it's going to be a lot of miles.
It's a lot of miles. It's right now 54 cents per mile. It's just, you can get so much back.
So basically, folks who drive a lot of miles should probably be taking the
mileage.
mileage deduction.
Anyone who is traveling more than about 9,000 miles per year should be
Really?
taking
Wow.
the mileage. Yes.
Okay.
Wow.
Now, obviously, they can't take mileage for personal use. They have to separate the personal use from the business use.
And that would be in the tracking we were talking
Right,
about.
there we got to tracking.
Tracking, yeah.
All right. Well, are there some other things other than vehicles where tracking makes a big difference?
Sure. Number one, if you're in a what they call a Schedule C sole proprietor business,
Right.
you have the ability to write off a portion of your home. And that again relates back to your mileage. If you take a home office, which I've found many people are afraid of, but which the IRS created, so I'm not sure why they're afraid of it.
Well, I actually, with home, steer people away from it for two reasons.
Okay.
Number one, it's a red flag for an audit because most people don't track it that well.
Okay.
And it also affects when you sell your home because
Sure.
you've basically you've taken a deduction. So it does skew the numbers when you sell your home if you've done that.
I'm going to have to argue with you on this one.
Okay, good.
The average home office comprises about 8% of the entire home. So you're looking at depreciating the 8%, and I agree with you. On that point, gee, why do we want to depreciate our house? But the current laws say that if I don't end up with more than a $250,000 gain, then I'm not going to owe tax anyway. The second thing is that the mileage comes into play because now I have a home office that I can start to deduct the mileage the minute I leave the house.
No commuting miles.
No commuting miles. So
We're
if
going to
I'm
have
getting
to take a little break here.
Absolutely.
And
Well,
we'll
let's
be
talk
right back.
and talk more about tracking.
Absolutely, yes. And we're back. You know, John, I think that part of where the concerns about home businesses comes from is when you've got these folks that have these little, I'm going to do it myself at my home kind of thing. They sell a product line. I'm not going to name names, but where they're running a business that's not really a business.
it's more of a hobby.
Exactly.
Right, and it can be used as a tax deduction, but we always tell our clients, if you're not really working towards building the business, if it's just something that you're doing, you're making money that you have to report, then yes, lay off the home office. Never be greedy on your tax return. Take what's owed to you and report, okay?
You know, it's funny. I like to tell clients that the IRS doesn't really care so much about how much taxes you pay or don't pay as long as you're following the rules. Agreed? I mean, it's more, you get in much more trouble
Well, I think
if you
the key
don't.
is following the rules, and that
yes.
means report your income and take your deductions.
But doing it
And take
properly.
every deduction that you can get. Render
Sure.
unto Caesar what is his, and take every other dime you
Exactly.
can. All right? But do it legally, and that's our position. That is what our responsibility is as preparers. We've got worksheets, for example, that we distribute every January that have over 200 possible deductions for self-employed people, for medical deductions, charitable giving. For example, charitable giving, people write off all the time. They come in with a goodwill slip, and there's no price on it. There's no value.
Right.
Well, we've handed them out these forms that they now keep on the refrigerator, and they have prices connected to them. All they do is keep track of the hash marks and add them up at the end of the year. We found that deduction going up by 15%.
Oh, that's wonderful.
It is wonderful.
Very helpful.
You know, that's an interesting thing, because I do make contributions from time to time when I get rid of old stuff to Goodwill, but I'm always itemizing what's on it before I go, because they don't do that. They just give you a slip and they sign it.
Do you know why? Goodwill got sued years ago by putting a value on it. Way back when, back in the 80s, and so they stopped doing it.
Yeah, you have to put your own value on it.
That's right. It should be your own value, right? Okay.
And it has to be reasonable. I mean, let's be careful. It's got to be reasonable. You can't donate a used coat hanger and call it $1,000. So
Well,
we've seen it happen.
Let's get back to the broad issues. I know
Yes.
you mentioned a Schedule C, and I want folks to understand that a Schedule C is on your personal income tax return.
Right.
And for a married couple that's operating a business, they can actually take an LLC return and do it on their, if they're their only two owners, they can actually put it on a Schedule C rather than a separate return. I know a number of accountants that do that.
Sure.
But the bottom line is, for a lot of small businesses, they do file separate returns that are actually pushed onto their individual tax return.
Like an S Corp, for example?
Sure.
Mhm.
I mean, they obviously, those entities are not actually paying the tax. They simply report their numbers, if you will. And
They're
then
pass-through.
they're pass-through entities.
Right. Mhm.
And then you have C Corps that are not pass-through entities.
Double
they
taxed,
pay
right.
their own tax. And actually, I know that actually some C Corps that don't make too much money, I think it's a $75,000 threshold, where they actually can come out better, even though they're double taxed.
Right. It depends on if you're going to take the money out or leave it inside.
I want to back up just a second, because I know what a pass-through is, and I know you do, and I know you do. I don't know that everybody does. So let's back up
Sure.
and talk about what pass-through is for a minute. And
The S corporation doesn't pay any tax. It simply records income, expenses, and a number is at the bottom, hopefully a net profit. That figure passes through to your personal
right.
return.
So does a limited liability company.
Well, and I'll say this as it relates to many startups start out as an LLC taxed as either a partnership or as an S Corp.
Right.
And one of the reasons that they do is not only for limited liability, but they do it because if they have losses, they can take those losses on their individual return. With a C Corp, you can't take losses. So if you start a business and it goes under, you can't take that off.
It has its own life. A C Corp has its own life, and it's completely separate of you.
And of course, sometimes for companies that are very profitable, with C Corps, they can actually do a lot more benefit planning in a C Corp
Sure.
and take more money out that's deductible to the company. So
Sure.
there's those possibilities as well.
So really what you're saying is choose the correct structure.
Right.
And you're going to need a tax planner to do that.
And even with an S
start
Corp,
there.
you can have a lot of employees. It's what, 100?
You,
Up
you-
to 100 employees
You can go
on
up
an
to
S
100
Corp?
shareholders, right.
Yeah. So until you get into a big company, I don't, to
Well,
me,
an
a
S
C
Corp does have some limitations, particularly for foreign investors and things like that. So you have
Correct.
to be very careful depending on
Yeah.
who's in there. I'm sorry.
Oh, just wanted to add, I mean, on the S Corp, you're exactly right. Some people want to go S Corp, they shouldn't be there. Some want to go LLC, they should be in an S Corp. But from the S Corp stance, what I see most often when people walk in with their corporate return and they want us to review it to see if they want to work with us, is that the other preparer wasn't taking deductions that are available to the S Corp owner, specifically for employee benefits, for their own benefit plan, for their own pensions, and again, back to writing off the cars and how to protect those assets from someone maybe suing the S corporation, which we have never seen, but it can happen. So that's the planning portion of it.
All right, so we'll be back in a minute, and we'll try to wrap all of this up. And we're back. So, Bill.
Well, we were talking about S corps and LLCs. What are some of the deductions that owners can take in those entities?
Well, the first one, again, we're going to go back to that auto mileage in the cars. I get a lot of calls where individuals ask me if they should put their truck or their vehicle into the S corp. And at that point, that becomes an asset of the corporation. You as a person do not own that car anymore. So if you want to keep the asset out of the corporation and away from any kind of lawsuits, you're going to want to keep it in your own name. And then the question becomes, how do I write that off? Well, many times I don't see what's called an accountable plan put into the S corporation. And an accountable plan is an employee handing their mileage to the company. The company reimburses the employee, so it's not income, but the company got the deduction, and the employee has the car.
So an accountable plan allows the employee to be reimbursed. That's not taxable income, but the company gets the deduction for having made that payment.
And the car's safe.
That's pretty good.
Now, I have an awful lot of folks that come to me that have small businesses and it's just a sole proprietorship.
Mm-hmm.
And so if they're thinking about upgrading to either a corporate structure, an LLC or an S corp, can we summarize some of the broad differences between the two?
Sure. The biggest difference and the reason people gravitate originally towards an S corp is that on a sole proprietorship, an LLC, or a partnership, you incur what you called the FICA tax, which for all of our W-2 employees out there, if you take out your paycheck and you look on it, you'll see Social Security and Medicare. And if you calculate the percentage, you pay 7.65% and the employer pays 7.65%.
Unless you're the employer.
Unless you're the employer, then you pay both.
15.3.
15.3.
I will just
That's
say
huge.
this, because my preferred entity for most small business people is an LLC, but an LLC has the opportunity to file as an S corp, because you get to check the box when you basically get your EIN number,
Right.
which is your tax ID number for the business. So you can be an LLC but be taxed as an S corp.
Good point to make, absolutely. Just, yeah, there is a little bit of a hybrid there, absolutely. But the gravitation is towards trying to get rid of that 15.3%. First of all, that's your Social Security.
Yeah.
So when people come and they say, gee, I can save money by being an S corp, it's like, hold on a second, do you realize the impact of what you're doing? So if you're going to save that money, please put it into something long-term like a 401k, an IRA. This is your retirement.
Well, part of it too is you want to put enough into it to where you're going to max out your Social Security without overfunding.
Correct,
Right.
absolutely. And besides that, the IRS says if you don't, you must pay yourself a reasonable compensation if you're in an S corp. And if you don't, they can deem you as being self-employed and go back 3 years and charge you the 15.3. Now,
Ooh.
I've not seen it happen, but that is the law.
Sure.
So yeah, I remember somebody saying that the IRS's motivation is going to be directly proportional to what they think they might get back out of it.
Sure, sure. Go for the person with the deep pockets.
Exactly.
Just like any other business.
Well, it is a business in a way, isn't it?
Now, the other part of that coin is they're going to go towards the big pocket, or they're going to go towards the guy who's just flagrantly trying to deduct things that shouldn't be. And that's where the flags come in.
Yes.
There's another big deduction out there that a lot of small businesses don't realize, particularly if they're young enough to do it, and that's long-term care insurance. That
Right.
you can deduct that, and it can be discriminatory. In other words, you can provide it for yourself and your spouse as business owners, but not provide it for the other employees.
Right.
Exactly, and that's huge. And if we take a look at how long we're living, and that possibly our Social Security benefits are going to be put to age 69, then we need to have the long-term care because we're going to be working longer.
Well, John, we're getting towards the end of the program, and I want you to have the ability to tell us about Rakoski and Associates.
Yeah.
I've been in the business 34 years. We provide tax and financial planning for over 750 people in the Triangle area. Those people, for the most part, at 90%, are state workers. So
We're going to have to take a break, and then we'll come back, and then we'll continue with that.
Sure.
So, John, why don't you tell us about the business? How do we get a hold of you if we wanted to?
Sure. We're located in the Triangle in Raleigh. We can be reached obviously on the internet at www.rafginc.com, or our phone number is all over the internet. You'll be able to find us easily.
Or we could just Google Rakowski and Associates.
If you did that, you'd see our 95 reviews, 5-star reviews. Yes.
There you go. Well, I'm Mike Tove with AIN Services. We can be reached at 800-363-2296. We do insurance and financial planning.
And I'm Bill Alexander with W.G. Alexander and Associates. We're focused on estate planning, elder law, and asset protection planning, which is so important. And I would invite you to be my guest at my radio show for Asset Protection Today at 11 a.m. on WPTF.
And thanks for watching.